Thanks, Chairman. And Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Seek unanimous consent to submit one opinion piece and one article related to some of the root causes of California and Florida's problems.
Objection, so ordered.
One of those was actually co-authored by Mr. Theodorou. Mr. Theodorou, I want to go back to, I think, a very important number that Senator Scott touched on too. Said for every dollar of premium taken in, you paid out $1.02. Is that correct?
That's right.
Okay, so for the premiums that they judged were necessary to cover their risk, they were off by 2 cents on the dollar that year, right?
That's right.
And fortunately, they have a hedging strategy where they have investments that hopefully have a return to make up those losses. So would it be fair for anybody to say that the insurers who are paying out more than they're taking in premiums are making money hand over fist and greedy?
No,
based on the data?
The data says they're not. The 2022, there was a 4% margin, profit margin, because investment income kicked in about 600 basis points. And long term, the insurance industry has got a return of 6.5%. Companies that are publicly traded have about 14 to 15%.
Yep.
So the insurance industry has a much smaller margin than other industries.
So we're, a part of what we could be doing here is considering national policy that is trying to address some of the shortcomings that, in my opinion, exist as past policy that's been passed in states like California. You mentioned Prop 103. You took a look, they're addressing some of the problems in Florida through tort reform. I'm glad they got on board. We did that 10 years ago in North Carolina. But there seems to be a suggestion here that we just don't have enough regulations in place at the state or federal level to fix this problem. Do you actually think there are glaring gaps in additional regulatory measures that we should take to fix this problem?
No, I don't. I think that the push to establish some sort of, or to introduce some sort of federal backstop or support, however well-intentioned, would backfire because contrary to popular opinion, the reinsurance market and the primary insurance industry is not on its knees. It's not collapsing. It's in the business of dealing with catastrophes. There are cycles in the business. Inflation and interest rates are factors beyond its control. But in the mutual insurance industry, there's companies that have been doing business for 200 years. You can't be greedy for 200 years and not lose all your business. So they're doing something right, and they've been through storms before.
Do you think that there are many corporate boardrooms that have a strategy on shrinking their market size as a part of their growth strategy?
Only in states where they can't make a dollar.
Right. So the point is, why on earth would a major insurer exit California and Florida? Because they can't make the numbers work. They can't sustain it. And we know why. So I think a part of what we have to examine here, to the extent the federal government should get in, is examine the policy decisions made at the state level that are creating these structural problems that cause insurers to exit markets. I don't know how we actually get and address you listed off, Ms. Norris, 3 key areas that need to be addressed. We need to address all of them. I just don't think that we accomplish that through some sort of a centralized, more burdensome regulatory construct coming out of Washington. I think there is a way to fix this problem, and I don't think it's with a big federal government solution to the problem. I think it's working through the root causes and looking. You can draw a nexus between policy decisions made and why you've exited the market. I do like what you've said about affordability. Mr. Heller mentioned affordability. I think that we should find, we do have people who are seeking insurance that they'd prefer not to be on that property anymore. We fail with FEMA. We fail with resiliency measures. We fail with movement. I've got property owners. We've had 53 tropical cyclones impact North Carolina over the last 20 years. We average landfall of a major storm in North Carolina every 4 years. I've been dealing with this for the 16 years that I've been in elected office. But I don't believe the mindset that some of my colleagues have here is that this can be fixed in Washington. It needs to be addressed on a state-by-state basis. We have to provide a backstop for flood insurance. We have to address these problems. But it's not going to come from compelling a private sector business to serve a market that cannot be sustained with all the constraints that they have on rating for the risk. I did have one final question, and Mr. Heller, I just want to confirm what you said, and then Ms. Theodorou, I'd like to get your opinion. You said that credit risk rating alone could increase a premium by as much as 80%?
Yes, sir. We see premiums actually jump for people with low credit, but no claims history, low, personal credit history, up by as much as 100%, sometimes doubling of their premium just because of their
Mr.
credit.
Theodoro, could you explain to me why you believe a part of the actuarial process should include a credit risk rating?
The credit score, insurance-adjusted credit score, has been found to be correlated with losses. The industry, though, I think, or from what I know and from my experience as an underwriter, doesn't overprice policies because of credit scores. If it did, competitive forces would come in and issue a policy.
If it wasn't relatively correlated to the risk, it wouldn't be a factor in the actuarial process. Okay, thank you. Thank you all for your testimony.
Senator Tillis,